Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we continued our discussion of the euro with a look at its introduction and some of the major fundamental factors which are going to determine the currency's long-term direction. In today's lesson we're going to continue our free forex trading course with a look at the major economies of the eurozone, as well as the indicators which give us insight into those economies and where we can go to find out more information about those indicators. So let's get started.
As you can see from this graph, member countries Germany, France, Italy, and Spain make up over 75% of the Eurozone's GDP. As a result of this, economic data out of these countries has a tendency to move the euro the most, so traders naturally pay them more attention. There are literally thousands of economic numbers released in the Eurozone. However, like we covered in Module 3 of this course, those that affect the current account, trade flows, or interest rates, capital flows, are going to have the greatest potential to move the currency. All of the indicators which we cover in Module 8 of our Basics of Trading course have a counterpart in the European Union. Most of the time, they are also named the same, and as they show the same things, traders can expect the market to react accordingly. The only thing to keep in mind here is that the economic climate in the United States versus the Eurozone will differ at times, so traders and therefore the market may react differently to the same number out of the EU than they do in the US. The second thing that is important to understand about EU economic releases is the different mandate of the European Central Bank versus the Federal Reserve. Where the Federal Reserve has a dual mandate of maximizing employment and maintaining price stability, the ECB's mandate is solely to maintain price stability. With this in mind, the ECB is normally seen as more hawkish than the Federal Reserve, meaning that they are more likely to hold steady or raise interest rates when economic data shows price increases, and less likely to cut interest rates as quickly as the Fed when growth in the Eurozone slows. I could spend many lessons covering each of the economic indicators and their relative importance to the market, but in the interest of maximizing our learning, I'm going to instead defer to two free sites that do an excellent job here. The first site is fxwords.com, and specifically their page on Eurozone economic indicators, which I've included a link to below this video. As you can see here, they categorize the major economic reports and then list them out with stars representing the relative importance of the indicator to the market. If you click on the link for each indicator, it will take you to a page giving a definition as well as commentary on how traders should expect the release to affect the markets. Once you have an understanding of the economic indicators, then you can get the date, time, and forecast for the release from the global calendar, which you can find by clicking the calendar link at the top of dailyfx.com. As you can see here, the importance of the indicator to the market is also indicated with stars on the calendar, and the important indicators have links where you can click to go for more information. That's our lesson for today, and that wraps up our series on the euro. In our next lesson, we'll look at the next most actively traded currency in the world, the Japanese yen, so we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section below, and good luck with your trading.